Hey everyone, welcome back to Finergy, the channel that helps you master your money and achieve financial freedom. If you're new here, make sure to subscribe and hit the notification bell so you never miss out on our tips for financial success. Today, we're diving into one of the most important aspects of your financial life, your credit score. Your credit score impacts almost everything from loan approvals to interest rates, and it can even affect your job prospects in some cases. But don't worry. Improving your credit score is totally possible, and I'm going to walk you through the steps you can take to raise that number and unlock better financial opportunities. Let's jump right in. 1. What is a credit score? Before we get into how to improve your credit score, let's quickly review what a credit score actually is and why it's so important. Your credit score is a 3-digit number that reflects your creditworthiness. Basically, how likely you are to pay back borrowed money. It's calculated based on several factors. And here's how they break down. Payment history, 35%. This is the most important factor. It includes any late payments, defaults, or bankruptcies. The better your payment history, the higher your score. Credit utilization, 30%. This refers to how much of your available credit you're using. The lower your credit utilization, i.e., the percentage of your available credit you use, the better your score. Length of credit history, 15%. The longer you've had credit, the better. A longer credit history shows that you're experienced at managing debt. Credit mix, 10%. This refers to the variety of credit accounts you have, such as credit cards, mortgages, or auto loans. A good mix can improve your score. New credit, 10%. Opening new credit accounts can lower your score temporarily. Too many new inquiries or accounts could hurt your score. 2. Why your credit score matters. Now that we know what a credit score is, let's talk about why it matters. Loan approvals and interest rates. Lenders use your credit score to determine whether you're a reliable borrower. A higher score can increase your chances of getting approved for loans like mortgages, auto loans, and personal loans. It can also help you secure lower interest rates, saving you money over time. Renting a home. Landlords may check your credit score when you apply to rent a property. A low credit score could make it harder to secure a lease or result in higher security deposits. Job opportunities. Some employers, especially those in finance or positions with high responsibility, may check your credit score as part of the hiring process. A poor credit history could be a red flag. Insurance premiums. Did you know that your credit score can also impact your car insurance rates? Insurers may use your credit score to determine how likely you are to file a claim, with lower scores often resulting in higher premiums. 3. Steps to improve your credit score. Now let's get into the actionable steps you can take to improve your credit score. Check your credit report for errors. The first thing you should do is check your credit report for any errors. Sometimes mistakes can happen that negatively impact your score. You can request a free credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, once a year. If you find any errors, dispute them immediately. Common mistakes include incorrect personal information, accounts that don't belong to you, or payments that were reported late when you actually paid on time. Pay your bills on time. Your payment history accounts for 35% of your credit score, so it's essential to make your payments on time. Set up reminders or automatic payments for your bills so you don't miss any payments. Even one late payment can cause a significant drop in your score. If you're struggling to make payments, contact your creditors to discuss possible solutions, like a payment plan or deferring payments for a short time. Reduce credit card balances. Credit utilization accounts for 30% of your score, so it's important to keep your balances low. Aim to keep your credit utilization below 30% of your available credit limit. For example, if you have a credit limit of $1,000, try not to carry a balance of more than $300. If possible, pay off your credit card balances in full each month to avoid high interest charges. Avoid opening new credit accounts. Each time you apply for a new credit card or loan, it results in a hard inquiry on your credit report. While a single inquiry may only cause a slight dip in your score, multiple inquiries in a short period can negatively affect your credit score. Try to avoid opening new credit accounts unless absolutely necessary. If you're planning to apply for a major loan, like a mortgage, it's especially important to avoid new credit inquiries in the months leading up to your application. Pay off debt. If you have existing debt, work on paying it off as quickly as possible. Focus on high-interest debt first, such as credit card debt, before moving on to lower-interest debts like student loans or mortgages. The less debt you have, the better your credit score will be. Consider a secured credit card. If you're just starting to build your credit or recovering from bad credit, a secured credit card can be a good option. With a secured card, you deposit a certain amount of money, usually a few $100s, into a bank account, and that amount becomes your credit limit. Using a secured card responsibly and making timely payments can help you build or rebuild your credit score. Become an authorized user. If you have a family member or friend with good credit, ask them if you can be added as an authorized user on their credit card. You don't need to use the card yourself, but being added as an authorized user can help boost your credit score by adding their positive payment history to your credit report. 4. Long-term strategies for maintaining a good credit score. Improving your credit score takes time, but maintaining a high score requires ongoing effort. Here are some long-term strategies to help you keep your score in top shape. Keep old accounts open. The length of your credit history accounts for 15% of your score. To improve this, keep old credit accounts open, even if you don't use them regularly. Closing old accounts can shorten your credit history and lower your score. Limit your debt. To maintain a healthy credit score, avoid taking on more debt than you can handle. Monitor your spending, create a budget, and only take on debt when necessary. Monitor your credit regularly. Keep an eye on your credit score to ensure it's moving in the right direction. You can use free tools like Credit Karma or Mint to track your score and receive alerts when there are changes to your credit report. And there you have it, everything you need to know about improving your credit score. Whether you're just starting out or trying to rebuild your score, following these steps will put you on the path to better credit and a brighter financial future. If you found this video helpful, please like, subscribe, and share it with anyone who could benefit from this guide to improving their credit score. Let me know in the comments if you have any questions or tips of your own. Thanks for watching, and I'll see you in the next video.